Hello and welcome to the Commodities Institute podcast. I'm Emily Costa and today is Wednesday, January 28th, 2026. We have one of those weeks where policy decisions and production data are colliding in a way that could genuinely reshape trade flows across several commodity markets. From oil sanctions and Iraqi contract terms to record iron ore output, tightening aluminum fundamentals, stressed US power grids and shifting agricultural trade routes, there's a lot to unpack. So let's take our time and walk through what really matters. Let's begin with oil, because geopolitics is once again steering the tanker. The United States is preparing what could be a significant change in its approach to Venezuela's energy sector. Instead of issuing case-by-case exemptions for companies wanting to operate there, officials are working toward a general license that would ease certain sanctions more broadly. That may sound procedural, but in practical terms, it could accelerate the return of Venezuelan crude to international markets. Over the past several years, sanctions have severely constrained Venezuela's production, exports, and ability to maintain infrastructure. Output has seesawed depending on how strict enforcement has been. At one point last year, exports were running close to 1 million barrels per day, only to drop sharply after tighter restrictions and a maritime blockade reduced flows to roughly 500,000 barrels per day. More recently, limited authorizations have allowed some trading houses to lift cargoes, helping drain millions of barrels from storage, but large volumes remain stuck in tanks and on vessels. A general license would make it easier for a wider group of companies to move oil, invest in fields, repair facilities, and stabilize refining and power systems that are essential to sustained production. The key takeaway here is not that Venezuelan supply will suddenly flood the market tomorrow. Years of underinvestment and infrastructure decay cannot be reversed overnight. But a clearer, broader sanctions framework could create a pathway for gradual, measurable output gains. In a global oil market that is always balancing tightness against spare capacity, even a few 100,000 additional barrels per day over time can influence price expectations. Staying with oil, but shifting continents, Iraq is also in focus. This time because of contract terms rather than sanctions. One of the world's largest oil fields, West Corner 2, has been nationalized after its previous operator ran into sanctions-related complications. Now, Iraq is in talks with Chevron about potentially taking over the project, but there's a catch. Chevron wants improved financial terms. This matters because Iraq has been trying to reverse years of underwhelming investment by making its contracts more attractive. The country has already moved away from older service-style agreements that offered slim margins toward profit-sharing structures designed to lure back international majors. If West Corner 2 is restructured under more favourable terms, it could signal that Iraq is serious about making large, technically challenging fields commercially viable again. For global supply, the longer-term implication is that Iraq may be better positioned to lift output beyond current levels, though, as always, timelines depend on politics, infrastructure, and OPEC-related constraints. Now let's pivot to metals, where production data is telling its own story about supply resilience. Brazil's Vale has just reported its strongest iron ore output in 7 years, surpassing the level mined by Rio Tinto's flagship Australian operations for the first time since before the Brumadinho Dam disaster. Vale's recovery has been gradual and closely watched because iron ore sits at the heart of the global steel industry. Higher Brazilian output helps diversify supply away from Australia and adds volume into a market that has been sensitive to weather disruptions, logistics bottlenecks, and swings in Chinese steel demand. While prices ultimately hinge on construction and manufacturing trends, steady growth from major producers tends to cap extreme upside unless demand surprises strongly. Aluminum is a different story. Investment banks are lifting price forecasts for the first half of next year, pointing to relatively low global inventories, uncertainty over power availability for new smelting capacity in parts of Southeast Asia, and solid demand from electric vehicles and grid expansion. Aluminum is incredibly electricity intensive to produce, so energy constraints directly limit how quickly new supply can come online. At the same time, electrification trends, from cars to transmission lines, are structurally supportive for demand. The market is not in outright shortage, but it is tight enough that any disruption, especially on the power side, has an outsized price impact. And that brings us neatly to power markets themselves, because the United States is currently seeing a real-time stress test. The largest regional power grid in the country has been operating with an unusually thin margin as frigid weather knocks generation offline and pushes demand toward record winter levels. A significant share of the outages is tied to natural gas-fired plants struggling with fuel constraints and cold weather performance issues. Why does this matter beyond electricity bills? Because power reliability feeds directly into industrial activity, data center operations, and even metals production. It also underscores a broader theme we talk about often, as grids become more dependent on weather-sensitive resources and as electricity demand rises due to digital infrastructure and electrification, the system becomes more complex to manage. That complexity can translate into price volatility across both power and fuels. Let's move now to agriculture, where trade flows are being reshuffled by diplomacy and policy. Chinese buyers have recently stepped up purchases of Canadian canola, following high-level talks between the two countries. These cargoes represent a meaningful share of China's import needs and could displace shipments from other origins, particularly Australia. Canola is crushed into cooking oil and protein meal for animal feed, so it sits at the intersection of food inflation and livestock economics. When a major buyer like China adjusts sourcing patterns, it affects basis levels, freight demand, and farmer planting incentives in multiple regions. At the same time, Russia is signaling a strategic shift in how it sees its role in global agriculture. Rather than focusing only on exporting raw grain, it is increasingly promoting its seeds and farming technologies abroad. The logic is straightforward. As more countries try to boost domestic production for food security reasons, the growth in straightforward grain imports may slow. Supplying inputs and know-how becomes another way to stay embedded in global food systems. Before we wrap up, a quick note on energy companies in the Asia-Pacific region. One major producer has reported strong recent output, but is guiding to slightly lower production next year due to maintenance and project timing. This is a reminder that even when long-term supply growth looks solid, short-term operational factors can create temporary dips that traders have to price in. So what ties all of this together? Across oil, metals, power, and agriculture, we are seeing a common thread. Supply is not just about geology or weather. It is about policy, contracts, infrastructure, and political relationships. Sanctions can sideline millions of barrels. Contract terms can determine whether giant fields are developed aggressively or cautiously. Power grid constraints can shape metals output. Trade agreements can redirect crop flows across oceans. For anyone watching commodity prices this year, understanding those structural levers will be just as important as tracking inventories and weather maps. That's all for today. If you found this episode valuable, be sure to subscribe, share, and leave a review.